So our next presentation is familiar to a lot of people here. Alvopetro Energy, Corey Raton, CEO. Corey is gracious enough to come back and present here whenever I ask him to. I sort of shake my head with this stock because I don't really understand it. It's still, I think, probably one of the best ideas I've ever written, and I still think today it's cheaper than most of the things that I see out there. I don't have a good explanation for what happens in the market every day with it. I mean, there's been some issues along the way, but I just think it's a tremendous opportunity, and they have a new piece of production they've added that I think adds to the story. So I just think it's a great story. I think it trades at a significant discount, and I'll let Corey tell you the rest.
All right, thank you, Dave, and a lot of familiar faces, so thanks for having me back, and it's good to see everyone, and good to be back in Denver. So many of you know the Alvopetro story, but for those that don't, on July 5th of 2020, we became the very first independent company in Brazil to deliver sales-specified natural gas into the local market. I think one of the unique things for a company, especially a company our size, is that we control the strategic midstream portion of our business. And I think you'll see since we came on production, I think our results speak for themselves. We've been just delivering some very good results. We've got best-in-class operating profit margins, strong free cash flow generation, we've got a clean balance sheet, and all that supports this more disciplined capital allocation model that we developed quite a while ago, where we're looking to basically take half of our cash flows and reinvest that in organic growth, and take the other half and return it to stakeholders. Just a little, well, we'll get into our 2025 capital program, but the nice thing is it's all 100% organically funded, and I think we're looking to unlock an awful lot of, and you'll see, I think we're going to unlock a lot of value with that capital program this year. One of the nice things in Brazil, because of that strategic infrastructure position we've got, is we're uniquely positioned where we can very quickly convert natural gas successes into production and cash flow, and that's quite unique. Dave alluded to this, but we did also recently announce a strategic entry back into the Western Canadian Sedimentary Basin. So we've got 2 platforms now to invest in low risk, high rate of return oil prospects in Western Canadian Sedimentary Basin as well. And then last thing, just about the team, we've been working together for quite a while. The team in Brazil has been working together for over 15 years. At our 2 prior companies in Latin America, Pacalta Resources in Ecuador and Petrominerales in Colombia, we were able to grow those companies to over 40,000 barrels a day and manage exits on behalf of stakeholders totaling about $2.8 billion. So our pitch really is, I firmly believe that we offer an attractive investment proposition, whether you look at it on a value, yield, or growth basis. Like I said, we've been delivering some pretty strong results. We've got a clean balance sheet. At the end of last year, we had over $13 million of cash and working capital on hand, no debt outstanding. The chart on the top right highlights the reserve update that we did here earlier this year. Effective the end of last year, it's evaluated by GLJ. And what you can see is that black dash line represents our current enterprise value at about $121 million. So from a value perspective, we're trading, and if you see the middle bar that says 2P there, that stands for proved plus probable. So P50 value of our proved and probable reserves of about $328 million. So we're trading at about a third of our 2P NAV. And on a proved or P90 basis, we're trading at less than our 1P NPV. So a pretty good value proposition. The green bars there represent the values associated with our initial core asset called Cabaret, which I'll talk about. And then the orange stacking bars that you see there relate to our Murucututu project, which is a 100% owned project that we've got. And if you look at that combination of reserves as well as resource, it adds up to close to $800 million. So like I said, we're looking to try and capture a lot of that value with the capital program we're talking about. And then on top of that sits the Western Canadian stuff that we just recently had. From a yield perspective on the bottom right, we did just increase our dividend up to 10 cents US per share quarterly. That translates into a yield of about 11%. And since starting the dividend in the third quarter of 2021, we've already returned US $1.50 to shareholders, which represents about $54 million. So in Brazil, we're operating in the northeast part of the country in the state of Bahia. This is the oldest producing basin in Brazil. It's a pretty well-developed area that you can see on the map sheet here, an extensive network of oil and gas fields, pipelines, there's high-line power and highways running through here. It's a pretty easy place to operate. The main city is Salvador that you see on the bottom right there. It's a city of about 3 million people. And as you drive north out of the city of Salvador, you go through a major industrial complex here called Camaçari. So that's where most of the natural gas in the state of Bahia is consumed. And our operating area in yellow sits just 15 to 20 kilometers to the north of that. So we're in a really good location in the heart of the basin, and you'll see we're directly connected into the local distribution network here, which gives us a significant uplift on our natural gas prices and our margins. So the first project I'll talk about is Cabaret. This is the project that came on stream in 2020. It's a unitized field. There's 8 existing wells that you see here. All the production facilities are in place. We're a 56% working interest here. It's pretty well delineated between 3D seismic on the bottom right, and then you can see the cross section of the 8 wells that we've got here. The vast majority of the resource sits on the right-hand side of that main bounding fault that you see in the seismic, which is marked in black in this Caruaçu formation. The unit's been performing quite well. We did increase, along with our partner, the productive plateau of the field by about a third, up to over 21 million cubic feet a day. And then pretty soon here, starting this quarter, we're going to drill 5 additional development wells. They're the solid black dots that you see on the 3D seismic image on the bottom right-hand side. So moving on to our infrastructure and marketing solution here, this is a 100% Alvopetro solution. What we did here is we built an 11-kilometer pipeline from the Cabaret field. I can't even see this, you probably can't either. Straight to the west, and we built this gas plant that you see right here. So the gas flows into the facility right here. It goes through a mechanical refrigeration process. The condensate gets trucked out, and then the gas gets delivered into a newly built city gate right at our physical location. And our off-taker, Bahia Gas, they built that, and they extended their pipeline distribution network down to that industrial complex in Camaçari. So we sell directly into the market, 15 to 20 kilometers away. We've got lots of capacity to be able to grow here. The way our gas contract works is the price resets quarterly, and it's based on Henry Hub and Brent oil prices. Effective February 1st, our gas price reset to $10.55 US per MCF. So pretty compelling gas prices. And then lastly, the nice thing is that initial project, Cabaret, basically underpinned all these capital investments, and it basically pays for all of it. So any new gas we can bring on stream, this is fixed cost, so it's effectively free. And it really sets the stage for us to be able to unlock the rest of the potential in our portfolio, which sits just immediately north, and I'll talk about that here right away. So production-wise, this is what it looks like since we came on production in July of 2020. We posted some pretty strong results, I think. We did set pre-commercialization guidance at about 1,800 barrels of oil equivalent per day, which was equivalent to our working interest in the Cabaret asset, as well as the firm sales under our Bahia Gas contract. So you can see there's a big portion of time there where we significantly exceeded that. We were able to sell all that gas on a flexible basis to Bahia Gas. We expanded our plant in the third quarter of 2022. And then last year, we did have some impacts where Bahia Gas had effectively overcommitted to firm supply with all of their suppliers, and they did have some demand disruptions. So what happened at the end of 2024, Bahia Gas was able to reduce their overall amount of firm gas supplies, and at the same time, they were able to increase the amount that was coming from us by a third. And so what you've seen in the first quarter here is a pretty big uptick in our production, up 37% quarter over quarter. So I think we're off to a good start with that new contract that we signed at the end of last year for our firm volumes. So our strategy here is to add more 100% working interest gas production to get us towards our near-term objective, which is about 3,000 barrels of oil equivalent per day. So this slide just highlights the more balanced capital allocation model that I referred to earlier, with a model to take half of our cash flows and reinvest it and half return to stakeholders. So the chart on the left-hand side, the lines with the black dots represent the cash that's coming in every quarter, our funds flow from operations, and the stacking bars are the cash that's going out every quarter. So if the bars are below it, it means we're building cash. If the bars are above it, it means in that particular quarter we're using some of the cash. What you see at the beginning when we came on production, we weren't having to reinvest a lot of money because we pre-invested it all in developing what I showed you earlier, and we were able to focus on rapidly repaying the project financing debt that we put in place. We did that within the first 2 years of coming on production, so we're debt-free. We then introduced the dividend, and then more recently in yellow, you can see us reinvesting as well. So if you look at 2024, I think about 46% of the funds flow went to capital expenditures and 49% went to stakeholders. If you look at the pie on the right-hand side, since we came on production from Cabaret, we've actually had funds flow from operations totaling about $163 million. And 44% of it's been reinvested and 48% of it's gone back to stakeholders, with the remaining 7% of that wedge there representing that cash and working capital that we've built up. So moving on, about our Brazilian growth plan here, I think we've established a very strong platform and we're really focused on this now. Our near-term objective is to get, like I said, 3,000 barrels of oil equivalent per day, which is 18 million cubic feet a day, with a longer-term vision to double that, and it's going to come from two areas. The development plan that I talked about at the Cabaret unit with the 5 wells that I talked about earlier, and then the big opportunity sits immediately north of Cabaret. It's the kind of red blob in the other block of yellow land immediately north of that. This is 100% working interest, and we had a very successful completion late last year on our latest well, which is called 183A3. We're looking to follow up on that success with another well that's drilling right now. I'll show you what that looks like. And our plan is to migrate all that, those orange bars basically, into production and cash flow over the coming years that I showed you on the second slide. So like I said, this is a 100% working interest project. It's a multi-zone gas play. We've got some high-quality reprocessed 3D seismic. In the lower sequence, it's called the Gomo Formation, and then what sits right above that is called the Caraçu Formation. So the most recent well, you can see the well logs on the right-hand side there. We encountered, I think in total, 128 meters of pay, and 116 of that sits in that Caraçu Formation. What we did is we used some technology that's being deployed in North America right now to stimulate these wells more effectively. They're sliding sleeves. So everywhere you see there's an arrow there, we put one of these sleeves in, and what it allows us to do is to open the sleeve and very selectively stimulate that zone. And then it also gives us control over the productive life of the well, that we can open and close these sleeves. So it gives us a lot more control. But it's something, we were the first to deploy this in Brazil, and it's been working out quite well. We stimulated and opened 5 of those sleeves, the ones in green, and that well's been on production since September at over 2 million cubic feet a day and 50 barrels of condensate. So certainly above our expectations. And then the follow-up well that we're drilling is the white dot that you see on the 3D seismic right here, which is the 183D4 location, and we're currently drilling that now. And we can see a picture of it. So the image on the top left just shows in squares the 3 different well pads that we've got, and then you can see in pictures the red is all the pipeline infrastructure. You can see this asset's tied back into our UPGN through the Cabaret project. What you see here is just the final completion at the 183A3 location, and then off in the distance is the 183D4 well being drilled. This is our 197-1 well pad. So we've got 3 pipeline connected pads that we can drill at least 6 additional development wells that are all pipeline connected. And then this represents our kind of medium to longer term plan for this asset. All the red is existing infrastructure, so the 3 pads and the pipelines and 3 wells. Our plan is on a multi-year basis to, like I said, convert the reserves and resources into production and cash flow. We feel like we can do this organically from our cash flow as well, and the pace that we've laid this out. And you can see on the upper right, this asset alone has the ability to produce up to 20 million cubic feet a day. So with success here, we feel like we can double the size of the company on a production basis and more than double it on a value basis. So moving on, we did announce on February 5th our strategic entry back into the Western Canadian Sedimentary Basin. We're targeting the Manville Stack here. It sits in eastern Alberta and western Saskatchewan. You can see where the arrow's pointed there. It's a series of stacked sands. Depending on where you're at in the play, there's 8 different kind of zones that you can go after, but in a 3 to 5 meter thick sand, you can get an incredible amount of oil in place. It's a very high quality reservoir, like 30% porosity, and we're very excited about this. This is one of the hotter plays right now in the Western Canadian Sedimentary Basin. So what we're doing, this just shows the evolution of drilling technology. So if we think about a quarter section or a quarter of a square mile, this is kind of how you used to have to go after it. You drill buried wells, and you'd probably drill about 32 of them. And the next evolution would be long reach horizontal wells. You'd probably drill them a mile long, and you'd have 4 of them. And now the latest technology, this isn't oriented quite correctly, but what we did and what people are doing is we're now drilling long reach open hole multilaterals. So what you do is you drill down to the reservoir, you set intermediate casing, so you put like steel casing in the ground, and then from there you drill out open hole. And in our case, we drilled 6 laterals per hole, a mile long. So each, we drilled 2 wells here recently. We've got 15 kilometers of open hole exposed in those 2 wells, so almost 10 miles of open hole exposure to the reservoir. So pretty excited about this. What else did I miss? Yeah, and the idea behind this is what you're trying to do is maximize your reservoir contact through the drill bit, basically, instead of fracking. So you've heard a lot about fracking and doing that. This is kind of a different idea where you've just got a lot of hole exposed, and you just let the oil seep in. And as a result, you're not putting casing in the ground, you're not stimulating anything, which is quite expensive. You can drill these wells, very cost effectively. So this is what it looks like now. We drilled the first 2 earning wells, so we're now at 50% working interest in 22 sections of land, so 22 square miles of acreage. That's over 7,000 net acres to us. I think someone asked me a question earlier. When we announced this, a lot of people said, okay, well, why Canada? And I guess, if we walk through the evolution, we were looking for lots of opportunities to expand our inventory. Obviously, if we could acquire something that was connected or close to being able to be connected into our infrastructure in Brazil, that would have been a pretty high priority. But the reality is there's not many transactions, and the ones that do happen, they're very big and they're very expensive. And then when we filtered through all of these opportunities, we looked at this and we wanted to kind of create a differentiated risk profile here. And I think, one of the things that we're able to do, this rose to the top just because we're talking about shallow reservoirs, very low geological risk. There's very good well control through here. We've got an excellent and very competitive service company environment. And you'll see with what we've executed here, very low well cost, much lower well costs, and a huge inventory of potential opportunities. And we can do it on bite-sized bits. And we're operating in a capital-starved basin, so we think we're pretty well positioned here. And I think, we've got a great partner and we've already got a big inventory of locations. But to put this in perspective, so February 5th, we signed this farm-in deal. From that date, we got 2 locations licensed. We got surface access to 2 pads, constructed 2 pads, and drilled 2 wells with 15 kilometers of open hole, all within 45 days. And both wells were on production by the beginning of April. It's pretty remarkable. And the gross well costs here, the initial ones, because they include the pad and it's exploratory, probably close to $1.9 million, including completion and tie-in and all that stuff on a development basis, about 1.6 million Canadian. So not the real dollars, but Canadian dollars. You gotta multiply that by 0.7. So, we're targeting rates of return here approaching 100% payouts of less than a year. And it's on a pretty low risk basis. We'll start to announce production here. We'll have a partial month here for April, and then our first full month will be in May. So, yeah. So in summary, I firmly believe that we still offer a very attractive investment proposition no matter what your investing focus is. Hopefully you've seen we've been delivering some pretty strong results. We've got industry-leading operating margins, very attractive gas prices, a great balance sheet, and all that together helps underpin that more balanced, disciplined capital allocation model I talked about. For value investors, we're trading at less than our total approved NPVs, about a third of our 2P NAVs. And then for yield investors, our 10-cent dividend, that's about 11% yield with quarterly dividends paid in US dollars. And for growth investors, I think we've got a pretty exciting year ahead of us, both in Brazil and now Canada. Yes, sir.
What had the gas price been before the February adjustment?
It had been pretty stable. I think it was 10.70, but one before then.
February or down?
I think on Brazilian currency it went up slightly, but in US dollar denominated it went down like barely, like 20 cents or something.
So essentially that's a reaffirmation of pricing before rather than a meaningful adjustment.
Yeah. And if you take the futures pricing that's in the market right now, you'd expect to be in that $10 to $11 range for the foreseeable future.
Thank you.
Corey, on that 183D4 well, so it'll be done soon, like any time, is that right?
When it's done, we'll all know about it at the same time. Yes, sir.
Curious about the plan in Western Canada, how many wells you intend to drill this year, and whether you consider debt financing to accelerate that program.
Yeah, so there's ways to kind of force the pace at different levels when you're working with a partner. We're 50% here, but we've got a new relationship, so we're trying to kind of agree on a mutual basis, even though we could go as fast as we want. Right now, we've got 2 wells planned here, probably get drilled closer to the end of the second quarter, and then we'd probably come back and drill another couple wells for, in Q3 or in Q4. And then we decide for next year. Yes.
Plan for that going forward, is it a similar kind of business that you're running through Brazil stuff? Is it sole customer? Are you guys looking to do trade shop? What are you guys trying to do for, sale of the product?
Yeah, so there's like 5 or 6 different candidates. It gets trucked between 10, well, I shouldn't use miles, say 10 miles and 30 miles, and there's like 5 or 6 different off-takers. It prices at about 13, well, Western Canadian Select prices at about $13 below WTI, and then there's quality in trucking. But
It's crazy.
all right, well, I'm around, so if anyone thinks of any other questions, don't be shy.
Great.
Thanks.